Gautam Shah joins us now, he's founder and chief strategist with Goldilocks Research. Gautam, good to have you back. Dubai se वापस आ गए? I can see the backdrop has changed.
Yes, indeed.
Okay. 20,000, it may be psychological, it may be technical, but so far has acted as a swift or a stiff resistance for the market. Do you think we have a top in place, at least in the short term, and that could be 20,000?
Morning, Nikunj. Yes, I think we had a top in place because you just had all kind of ingredients coming in together to suggest that the market did top out at that level of 20,200. We've always read in the textbooks that when you have madness on the screen and madness on the charts is when typically euphoria happens, and when euphoria takes place is when markets top out. I think that was a classical case last month with large caps, mid caps, small caps, all running away at the same time, with all kinds of talks on the upside. So I think 20,200 was definitely a short-term top, which might not be taken out in a hurry. The market, given the way it's corrected in the last 10 days, has just validated that view, and the evidence that has come up on the hasn't looked good. In fact, we've been maintaining a cautious stance for the last 7-8 days, and we continue to do so. I think from a Dow theory perspective, we still need a break below 19,500, which I think is just a formality. And if and when it happens, the market has the potential to lose another 4 to 5%, at least, if not more. So I think things have changed quite a bit. In the last 4 or 5 months, whenever there has been a correction, we've always said buy the dip, be a buyer, because I think the market will go on and make new highs. But this time we have not maintaining that stance. So our stance has changed quite a bit in these last 10 days.
So for those who are watching the show and for those who will watch it on digital, should they now be locking some gains? If your advice is that the market, the path of least resistance is on the downside, is it time to at least book 25% profits?
Absolutely, 25% or more. I think in all the stocks and sectors that have run up substantially in the last 4 to 5 months, I think one should take profits. And one should realize that suddenly you have just too many headwinds. I mean, look at global markets. They've corrected quite a bit. Look at US markets, European markets, Asian markets. Look at what Hang Seng has done today. So many world markets have actually seen a large correction in the last 10 days. That's not look good. We are getting closer to the assembly elections. We are getting closer to the general elections. Oil has been quite a headwind, and FI money hasn't been as strong as it used to be. And let's not forget the big underperformance of Reliance and HDFC Bank. Two of the stocks where if you really compare it with the Nifty, you'll see that they are at 52-week lows on a relative basis. So these are not factors that are very positive, and I think the momentum will pick up on the downside below 19.5.
All right. What's the stance then, Gautam, when it comes to these stocks that have really powered up, the likes of the railway stocks, the defense stocks, which really boomed? Do you believe that, you need to be very selective when it comes to this space? Or now do you believe that the positive time or the party is really over?
I think the party is either over or close to getting over for most of these stocks and sectors. A lot of the basis was on the Excel sheet over the next 5 to 10 years. But, when trends turn abruptly, it happens really, really fast. And I think a lot of these stocks went through a parabolic move in the recent past. So I think railway and defense clearly are spaces where one should take profits. And, we are focusing on stocks which have quality institutional interest, because let's agree to the fact that there is still a lot of liquidity in the system. Domestic liquidity is coming into the mid caps and small caps. So fund managers in the mid cap, small cap space have a lot of money to actually commit in their own stocks. So I think what we are focusing on right now is committing into stocks with quality institutional interest, quality fundamentals, great structural stories, which I don't think will be impacted if the markets were to correct. But on a general basis, on an overall basis, mid caps and small caps, one should be aggressively booking profits here.
What could be the duration of the decline? Could it be a multi-month decline? Could it be just a bad patch which happens in a bull market, swift, sharp, before you realize correction has started, it actually is over?
It doesn't look of that variety, Nikunj. You and I have seen markets over a couple of decades, and every time this market tries to do something new. In the last 5 months, it was always a quick decline, so that bias is there in our minds that this time also something similar will happen. But when I look at the leadership, I clearly see it missing. We release our big picture report, a 47-page report yesterday describing the long-term trends. And if I were to just go by that, I feel that this could be a multi-week, maybe even a multi-month kind of a consolidation stroke corrective phase. So broadly, in terms of numbers, I think if we are able to stay in that 18,900, 20,400 kind of a band, and say till Diwali, I think we would have done very well for ourselves. But I do believe at some point of time, we could test 18,900 and possibly even 18,400, 500.
Not of the view that we could see a pre-budget or a pre-election rally, because that has always happened.
Well, things change, times change. In fact, a lot of smart money have been putting this question that should we actually take on the assembly election results? And I think a lot of people want to get cautious before that. So I don't think you're going to have any sort of pre-budget or pre-election rally. I don't think this time it's pretty much different. And let's not forget, we still live in a synchronized world. Till a month back, world markets were all positive or range bound. Then the Dow is now close to a multi-month low. The S&P 500 has stopped outperforming. The Russell 2000 in the US is actually near a 52-week low, despite all that we talk about the US markets. And European markets and Asian markets don't look good. So in a challenging global environment, global equities environment, and with oil continuing to rise, and I do believe NYMEX crude will move towards 104, given all of these factors, it doesn't seem as if the market will see a bump up very quickly.
Okay, and let's get in your view then as to what you believe is looking attractive as a buy right now. From just a stock-specific angle, if you were to pick out some of the large caps, where is it that you'd be betting on?
Well, I think we've moved to the defensive. So we love IT. I think we've been a big bull on the entire IT pack for a while now. We maintain that stance. And I feel in a difficult market environment, IT will stand out. And this 31,000, 31,500 area is an important support. Secondly, I think the sector that we feel could make a big comeback is pharma. I think it's very clear looking at Friday's action that the market has got into risk off mode. For the last 4 months, we were in risk on mode. So everything and anything that was high beta did well. Now, I think we've moved to risk off mode. And I think pharma could be a sector that could lead the market move from here in terms of strength, sectors doing well. And I do see the pharma index appreciating 15% from here. So our working target is about 17,000. So these two spaces look great. And autos, I know it's considered high beta, but if you really carry in the fundamentals and the technicals, I feel auto has the potential to be the big structural story for the next 6 to 12 months as well. So every small dip is a buying opportunity there.
Gautam, the entire engine or the propeller of this market are banks. Now, banks have not participated. Now, the technical theory is that the weakest sector would always lead the decline. Bank, which was supposed to be the strongest outperforming sector for 2022, has turned out to be the weakest sector. So could it be the banks, surprisingly, they actually could lead the decline, because technically that is the setup?
Nikunj, the writing is on the wall. Banks will lead the market down. I think they are a big heavyweight. SDFC Bank, despite all that is spoken about fundamentally, has been one of the biggest underperformers, not just for the last 5 months, but for the last 2 years. And as I just said earlier, the chart of SDFC Bank divided by the Nifty has actually seen a breakdown last week, and this underperformance is not going to end anytime soon. In fact, Bank Nifty is probably one of the few sectoral indices in the market to not make a new lifetime high, while the Nifty went to 20,200, while the mid caps did well, while many other sectors in the market did well. That to me was a big red flag. And now it is coming back close to the lower end of the range, which is around 44,000. If that were to break, I think 2,500 points could get shaved off on the Bank Nifty. So apart from the PSU banks, the top quality PSU banks that we still like, everything else is an avoid.
Okay, that's quite interesting. Gautam, as a theme, what one has seen is that across the board, PSUs are the ones which have been in the limelight. And I'm going to keep the banks out of this list. Your PFCs, REC, NTPC, this entire power pack as well has been at the fore. I can say the same about Coal India, and I can say the same about many sectors within PSUs. What's looking like a concentrated bet right now that even after the run-up, you can still go long on?
Well, sadly, you can't go long on not too many PSU stocks at these levels because, the rally has got parabolic, it's mature, everybody is talking about it. Fundamentals are pretty much understood, and it's starting to get a little over-owned. Now, if you have a 3-year view, I'm still very comfortable to hold on to PSU stocks because I think they'll do exceedingly well and they will outperform the benchmark indices by a wide margin. So in that sense, we love the setup of NTPC, Coal India, Power Grid, ONGC. I think it will do great things over a 3-year period. But if you're looking at the next 3 to 4 months, it might be a little challenging. So it might be more prudent to actually buy them on a dip. And in case the Nifty were to come down to the levels that we are talking about, you might get that nice dip coming in on the PSU stock. So long term, all good, very good. It was a breakout from a 10-year range, and that such breakouts do not end so quickly. Short term, little overdone. Wait for that pullback, then buy aggressively.
Okay, that's really the view coming in on some of those sectors. And Gautam, what about when it comes to tracking what's going on within the entire auto space? Do you have any favorites? Would you be leaning perhaps towards auto ang?
So I think there are two ways to look at the auto index at this point. One is in absolute terms, and you might feel that in absolute terms it's run up a lot in the last 4 months. No doubt it's done very, very well. But in relative terms, the auto index has actually seen a mega breakout from a 4-year range, which is auto index divided by the Nifty. And I see significant upside in the auto space over the next 12 to 18 months. So I remain a big bull. I think Maruti will continue to do well. Tata Motors at some point of time will hit 4 figures over the next 18 to 24 months. M&M has a great chart structure. So I think TVS Motors, I think, has been right up there. So this entire basket looks great medium term, short term, but if medium term, long term. But if you're looking at short-term returns, it's high beta. If the Nifty corrects, you might see some weakness. But on an overall basis, I remain a very, very positive on the entire basket, and the stocks which I mentioned, I would recommend commitment on any dip.
The other two heavyweights, Gautam, that I want to bring out right now, and they have completely been non-participative in this entire rally up onto 20K and beyond. Reliance and HDFC Bank. And what are you reading on the charts? I mean, when do we see a material move from both these heavyweights?
Well, you're not going to see a material move anytime soon. As they say in cricket, when the pitch is for 100 and if you're going to get out in 15 and 20, it means that you just don't have the potential to do well in the good times. And in the difficult times, obviously, you will get impacted. So we shared a chart in our big picture report yesterday where we highlighted that the relative strength charts of Reliance and HDFC Bank versus the Nifty is almost at a 52-week low. And I think this underperformance is going to go away anytime soon. Reliance just keeps correcting from that 2700 number. HDFC Bank, despite all the talk, hasn't really been able to see any kind of follow-up. And with what has happened in the last 15 days, I think it's going to get a lot worse. And the problem is both these stocks are supremely over-owned. So there is a case for a lot of selling pressure in these stocks over the next many weeks to many months.
Okay, but Gautam, then that's going to have surely a bearing on the Nifty as well, right?
That's exactly the view, Aisha. And I think it's all joining up quite beautifully, because when you have 40% of the market, where is the leadership? Reliance, HDFC Bank, ITC has pretty much done and dusted its uptrend. Banks in general haven't done well. L&T, I think, is very, very overbought at these prices. So when I look at the top 10 constituents of the Nifty, I don't get the feeling that we can make new highs in a hurry. So it does seem that over the next many weeks, maybe even many months, the Nifty just broadly stays in range and digests the news flow around the elections and oil and global markets, whereas stocks and sectors continue to do well. There will be pockets that will stand out: auto ancillary, sugar, infrastructure, power. There will be pockets that will stand out: unlock trade, hotel stocks. So concentrate on these pockets and not on the typical usual top 50, 100 names.
Okay, that's the view coming in. You're being very crystal clear as to where your preference lies, your view on the markets, and what the outlook is when it comes to individual stocks.